Hey folks, it's Professor Joyce back again with a review of the final exam of 2013, and I'm going to focus on problems 3 and 4 today, which again come from chapter 13, which we should complete this week of November 3rd. Okay. So here's the question. Ellie's been working for an engineering firm, earning an annual salary of $80,000. She decides to open her own engineering business. Her annual expenses will include $15,000 office rent, $3,000 for equipment, $1,000 supplies, $1,200 utilities, and $35,000 salary for a secretary bookkeeper. Ellie will cover her startup expenses by cashing in a $20,000 certificate of deposit on which she was earning an annual interest of $500. By the time this money is spent, she will have enough revenue from a new business to cover expenses. First question. Ellie's accounting costs for the first year will be what? All right, so we know the difference between accounting costs and economic costs is that economic costs include implicit costs, where accounting costs only include explicit or actual outlays of cash for goods. So let's write down costs, and we'll put dash ACC for accounting. So let's add up what she's got. So she's got $15,000 in rent, she has $3,000 in equipment, she has $1,000 in supplies, she has $1,200 for utilities, and she's going to pay secretary $35,000. And if we add all those up, we're going to come up with $55,200 are her expenses, her outlays for this business, and that would be the accounting profits, excuse me, the accounting costs. We can jump right ahead to the next question, and it says for Ellie's economic costs of the first year will be what? Well, we're going to have the exact same, so let's write this down, economic costs. And those include both explicit costs, which the accountant counts, plus implicit costs. And those are the opportunity cost of resources or money that she gives up in order to start this business. So we have, again, from the accounting side, we know there's $55,200 in outlays, right? That's the $15,000 here, plus this, plus this, plus this, plus this, okay? But now she has additional costs. One, she's an opportunity cost because she gave up $80,000 in annual salary from an engineering firm. So that is an implicit cost, and we'll put this implicit. All right, because it's an opportunity cost of her labor. This is an explicit cost because it's an outlay. And then again, she used $20,000 from a CD. That CD was earning $500 in interest per year, and she used that. So she lost that $500,000. Doesn't lose it. That's the opportunity cost of using the $20,000 for her business. So he says she gave up $500 in opportunity cost. Now, clearly she may make it back at this firm, but we don't know that. All we know is that this is one of the costs, or the implicit costs, of running her business. And if you add all this up, you're going to get $135,700 in total cost as an economist would see it. And why the heck do we do this? Well, now we're saying to ourselves, look, if she doesn't make at least $135,000, then she hasn't covered her costs. In other words, let's say she made $100,000 this year. Well, remember, given her expenses of $55,000, she would have $100,000 in revenue minus her explicit cost of $55,000. So the accountant would say, great, you cleared $45,000. But the economist would say no. The economist would say no. That $45,000 has to be judged against the $80,000 she could have made working in the other firm, which means for an economist, she would have lost $35,000. Okay, so she would have had a negative profit of $35,000 because we take profit to be, remember, our symbol for profit is equal to total revenue minus total cost. Well, the economist includes explicit and implicit cost in this cost item right here. And because of that, we have her total cost is $135,000. Now, again, there was nothing about income here. I just wanted to use that to illustrate it while I had the opportunity to pull your ear. All right, so there it is, problems 3 and 4, and I will stop there and